Welcome to the Brainstorm, episode 116. We're very lucky we have Cathie here today because over the weekend, there was some crazy news out there with Jerome Powell getting subpoenaed from the DOJ, threatening criminal indictment. This seems like it's, recently there's been a long line of issues and I'd say macroeconomic initiatives from Trump, from no institutional investors being able to buy single family housing, a cap on credit card interest. So Nick, maybe you'll touch on that later. And then also a $200 billion mortgage-backed security buy order to Freddie and Fannie Mae. So Cathie, where do you want to start on all of this? Is this the right move? Is that even not the right question to be asking? Where do you want to go?
I think President Trump is reacting to the elections in New York, New Jersey, and Virginia, which Republicans lost and were all about affordability. The two areas of affordability that seem to be bothering consumers most right now: housing and meat. We've gotten some grocery prices down. We've got gasoline prices down, but it's not enough. The consumer sentiment measures are really soft around this particular topic. So I think that's the reason he's just throwing a lot of ideas out there. As a free market person, I don't like this at all. But when it comes to the Fed, the criminal or the threat of criminal indictment is, I think it's one reason the gold price has just hit an all-time high. I'm a bit puzzled why Bitcoin isn't following gold, but we can get into that a little later if you'd like. But, I'm sympathetic with the idea that every time a Fed governor or a Fed president says something, it's become market moving and it's creating a lot of volatility. And personally, I don't like it at all. I've been around the block a few times, lots of different Fed chairs and different styles. And until this one, we just didn't have that kind of, or the number of market-moving appearances by Fed presidents and governors. So I think it's feeding high-frequency trading and, causing, from my point of view, way too much volatility.
Cathie, is there any precedent for this type of interaction between the president and the chair of the Fed? Like in your, storied career, you've seen a lot of these Fed chairs. Have you ever seen this type of interaction in public? Assuming there's probably conversations in private, but they're supposed to be separate institutions. Is there another time in history you can draw on that could give some insights into what is happening?
Well, I think it's a little bit different, but we ended up in the late 70s with double-digit inflation, double-digit interest rates, and there was a Fed chairman, Miller, who preceded Volcker, who basically said he didn't care about the dollar, and the dollar started imploding. It almost felt like we had become an emerging market. It took Fed Chairman Volcker his determination to bring interest rates and inflation under control. But first, he had to take interest rates up to, with surcharges over 20% in some cases. And so Reagan didn't say much about it, but a lot of policymakers and politicians did because it was hurting everybody. I guess homeowners were sending their keys to the Fed because they just couldn't afford. A lot of mortgages back then were adjustable, and so they just couldn't afford them. So there was a lot of consternation back then. But the circumstances were extreme, double-digit inflation and interest rates. That's not the case at all right now. And in fact, if we're right, inflation, underlying inflation, is probably under 2%. If you look at compensation per man hour in the latest report. That was up 3.9%. But if you look at productivity, it was up more than 2%, taking unit labor costs down to 1.2 or 1.4%. That is what in the old days used to be considered underlying inflation, because in the 70s we had cost push inflation coming from wages primarily. We don't have anything like that right now. So I'm just pretty astonished that we're at such heightened, well, I would say emotion on all sides, because we're almost there on inflation.
And so where do you think this shakes out ultimately, right? A lot of this is political ahead of the midterms.
Yes.
Like, what do you think actually gets implemented here? Does the Fed just get a new chairman and that person's more aligned with Trump and, we move on? Or, yeah, I guess how do you see this all shaking out?
Yeah, I think the reason that Trump is bearing down so hard on Powell is he wants him to leave. Now, May of 26, his chairmanship is done. That's the end of his term. However, his term as a governor does not end until 28. Trump wants that board seat to put his own person on. And to get his own way a little bit more. Now, you're right, they're supposed to be independent institutions. If I had my druthers, given how much trouble the Fed has created since 1913, when it was founded, I would prefer to go back to some kind of commodity standard or Bitcoin standard, some kind of standard, and take away, the people. Now, of course, that went too far, and so there will have to be human involvement. But I just think it's gone too far.
And what do
And
you think?
the other thing is, the dollar has lost 99% of its value since 1913. Prior to 1913. And Art Laffer has written tomes about this. Prior to 1913, the price level on average over time with private money was flat. Now, it was up and down. We were on a gold standard, so we had a lot of volatility around that zero, but on average, purchasing power was maintained. So we've got to get back to some hybrid situation like that.
And Cathie, what do you think is the biggest issue with the current structure at the Fed in terms of, you just framed going back to a different type of standard and looking at a different type of data set? Is it that they've been looking at the wrong data set, or these are just humans? Humans are prone to errors. And, I'm just curious why you think there's been so many issues and how that gets corrected.
That's right. We have to go to the trueflation standard.
Yeah.
Yes, trueflation, which is down to
seriously.
1.8%. So real-time monitoring of 10,000 items, we're at 1.8% inflation, trueflation. I think what happened, ironically, and we are big proponents of transparency. Well, this Fed decided to go more transparent and let all of the Fed governors out and talk, with the exception of some blackout periods. And I think that's worked at cross purposes just in terms of volatility. First of all, they're disagreeing with each other, and we have the dot plots, and it's just been altogether too much. I can tell you two other times in history that I thought worked much better. Now, Alan Greenspan, everybody made fun of him because he would come out on the day that the Fed had made an interest rate decision, and he would talk, and at the end of it, nobody would understand what he said. It was very academic. and kind of convoluted. But what I don't think people appreciated until after his departure was he was just using gold as his guide. If you look at the gold price during his tenure, it was extremely stable. And he was a big Ayn Rand devotee. And so that's what she would have done. And then the other time was under Volcker. He was determined to get inflation down. And so he was much more inclined towards the monetarist view, get that money growth rate down to 3% and hold it stable. That's where he wanted to go. It took a long time. We knew exactly where he stood, and so the only thing that mattered back then were the prices themselves. I remember it was the first time cereal hit $5 a box. And that was outrageous at the time. So we had a lot of talk about pricing, but that's what Volcker wanted. He wanted the focus on pricing because he was determined, and he was doing the right things to get inflation down. During that time, helping him were Reaganomics policies that really drove the dollar up almost twofold. And that, of course, was a massive anti-inflationary force. And I actually think that's going to happen again if we get this Fed controversy behind us. Because the Trump policies are Reagan's policies, and some of them are on steroids. So I actually think the return on invested capital in the United States is going to go up relative to that in the rest of the world, and that should drive the dollar up, which will help the Fed. That will mean they won't have to raise interest rates that much if we get into a very strong cycle, which I think we will. And in the meantime, I do think rates will come down because the unemployment rate will continue up. It's a lagging indicator. And artificial intelligence now is taking away a lot of entry-level jobs. So if you look at the unemployment rate for 16 to 24-year-olds now, it is at 12%. It's in double digits. And the duration of unemployment is up to 24 months on average. So I do think that the combination of inflation coming down, and I think dramatically, we could see negative inflation rates before all is said and done, especially if the dollar goes up. I think it's going to take the pressure off interest rates, and we're going to be in, I think, a very strong bull market. I'm very happy everybody's worried about this market, but I think we're in a strong bull market.
It is interesting to use that as a point when people say, oh, is AI even working, right? It's like the fact that it's impacting new grad hires suggests that, clearly you're getting a lot of productivity out of it.
Absolutely.
But maybe we can dive into a few of the specifics. Is the $200 billion mortgage-backed security buy order, is that just another lever to pull? And then, Nick, I know you were talking a lot about the 10% credit card cap and the implications there for buy now, pay later, and some of the other players, maybe airlines, whose economics are all over the place, get really caught off guard here. But Cathie, we'll start with you and then we'll go to Nick.
Sure. $200 billion in the mortgage-backed security market. That is multiple trillions of dollars. At the margin, I always think prices, yes, are made at the margin. I think much more important is in terms of interest rates is going to be inflation and the dollar. So this will mean very little, but I know that Trump will take a lot of credit for it, saying this is one of the things that he proposed and has been successful. So.
All right, Nick, 10% for credit card interest payments.
Yeah.
Good idea, bad idea? and implications. if it
An
actually goes
interesting
through.
idea. I mean, I think there's puts and takes, right? You look at the credit card industry today, I think the average APR is north of 20%. So you're cutting it in half, if not more, depending on, where you stand as with your credit score. But if you look at the broad-based implications, one, you have these high APRs, and then they're ultimately tied in, and they are helping out these loyalty and reward programs. And these loyalty and reward programs are huge businesses for both credit card companies, for banks, and also, interestingly, for airlines. And I think that is maybe one of the most interesting places to look. And I was going back and forth with Grok this morning and over the weekend, just trying to get an understanding of how big of a business is this loyalty and rewards program. And it kept coming back to airlines. And I want to point out a few stats. If you look at, and this is data for full year 24, because we don't have full year 25 yet. If you look at Delta Airlines, their reported operating margin with their loyalty program, which is really where you have high profit margin, on an operating margin basis, they were around 10.5%. If you were to strip out the entire loyalty program, get rid of it entirely, they would drop down to negative 2.5%. So you're talking about taking airlines that are on razor thin margins and stripping all of that out in the subsidy that loyalty programs provide, and they would go to actually negative operating margins. Delta isn't the only one. Grok points out it would happen to United, American, Alaska, Southwest, and then there's a few of the, call it low budget airlines that are already at negative operating margins. So it would be a huge move for this to happen, because when you drop the margin or the interest rate by 50%, you as an issuer of this credit, you have to rewrite your underwriting model to now adjust for the fact that you can only charge 10% at the high end. So either you're going to have to cancel millions of cards that you can no longer underwrite on a risk-adjusted basis, or you have to take away the subsidy that you've been giving to users that typically are paying off their debt and paying off the credit that you're giving them, and looking to get those rewards. And you have to either devalue the miles that you're giving, lower the overall package that you deliver, and that would be, I think, a big pullback from a consumer spending standpoint. Like, if you're not incentivized to spend on these cards in the way that we historically have, that would change the dynamic between credit. And I think, Sam, you alluded to it in your question. There are alternative credit options out there for consumers, more so than there ever have been. And a lot of these have much more transparent credit pricing and lower APR. And one of those that has become very popular in the last 5 years is buy now, pay later. So paying, you can think of layaway for what would have been in the old day layaway. Now it's more buy now, pay later. This has become very popular across a number of different fintech and neobanks. Square with their acquisition of Afterpay. You have Klarna, which is one of the largest players out there in buy now, pay later. Affirm, a number of different companies that are doing this. And I think this ends up being potentially a more attractive opportunity and credit for individuals that would no longer be able to get credit cards. This is a very attractive alternative. The other one is potentially just personal loans. So you can think of a player like SoFi that's out there issuing personal loans. Well, those are capped APRs. I don't think they're as adjustable as credit. And so those are typically also much lower. And you could imagine people taking out personal loans, assuming they can get underwritten on their credit score. So a really interesting time. We don't believe, or, right now it's not actually possible for Trump to enact this on Jan 20. According to the law, this would have to come from both House and Senate approval. So the Congress would have to approve this. But it does bring up an interesting consumer pain point, because there is a ton of credit card debt out there that is being charged interest that is north of 20%. So I think it will be a focal point, as you mentioned, Cathie, for the midterms. Like, I think this is positioning for the midterms to be on the side of the consumer. So we'll have to see what happens, but definitely one to watch, because there's a number of different ways this can go.
Yeah,
All right.
I'd add also that, like, one of the things that DeFi hasn't yet cracked is non-collateralized lending, but it's probably out there as an option that DeFi could plug into. And there's nothing like a government mandate that, hey, this specific thing can't happen, that crypto assets could step into and provide effectively that service outside of kind of like the fat thumb of government.
Yeah, disruptive innovation. The irony here is it's usually Senators Warren and Sanders who are proposing this issue. So there's definitely a political dynamic. But and just back to your airline example, they'd have to resort, if they were going to remain profitable, probably to raising prices, which is an affordability issue again. So, so yes, I think there's a great room for innovation to swoop in here and help the process along.
Yeah, and Cathie, to your point, there is legislation in Congress it was introduced by Bernie Sanders and Josh Hawley that would cap credit card rates at 10%. I don't think there's been any movement on it, but you could see that now coming to kind of the top of the list, so to speak, given the president's focus on it.
And the banking lobby
bipartisanship.
That banking lobby is so strong, so strong.
Yeah.
We're seeing it recently, even in recent days, with the legislation going through, the market structure legislation for crypto. It seems like banks are gunning for no rewards, no interest rates. So this is another angle.
Yeah, this was something I also queried Grok about, trying to understand which sectors are the largest presence in Washington through lobbying efforts. Number one would be health. So through Q3 2025, they spent around $650 million. The second, as you point out, Cathie, is the finance, insurance, and real estate sector that has spent just north of $500 million, according to Grok and OpenSecrets.org. So definitely a force not to be messed with if you care about getting reelected.
Absolutely.
All right, now a little bit of a jump to another topic, but I don't know if it's a crowd favorite. It's one of our favorite topics to revisit and revisit and revisit, and that is Apple, Google, OpenAI, and the competitive dynamics when it comes to foundation models. Nick, this just happened before we started recording, so maybe you want to give an intro to the topic, and then we can have Brett say why he still thinks Gemini is going to lose.
Yeah.
Well, no. Wait a minute. All
Wait,
right,
let me tee up the topic
it.
first, Brett, before we get into it. And Cathie, we need
Why are you
you to weigh
prejudging
in.
what I'm going to say?
We need you to weigh in because it's normally just Brett and I bickering back and forth. But the new news here is that Apple has put out a statement that, coming this year, Siri will be powered by Gemini, and they're going to use both Google's AI technology and their cloud technology to power future, and I think this is an important statement, future Apple foundation models. So this is the first time, I think there's been rumors that they have private cloud foundation models, but nothing really out there in the open. This is the first time we're hearing that they're actually pushing in this direction. But, we're seeing them tie up with Google, has been a formative competitor in the hardware space and software. These two have been arguably a duopoly in the smartphone era, and now they are tying up once again in the agentic and AI era. But I think it comes down to, my personal take is, this is the devil you know versus the devil you don't know, as in they could have gone with OpenAI or one of these startups. It's much easier to work with a company you've worked with in the past, right? They have the search relationship there, and it's better to maintain the duopoly than let a new entrant in, as an OpenAI, breaking through, creating hardware, creating headaches for Apple and Google. I think this is the reason they're tying up. It's like two monopolies monopolizing the next generation of technology, which is unfortunate.
Is this separate, Nick? Is this separate from Apple Intelligence, which has a partnership with OpenAI, or is this going to be like classic Apple, where if you click the lower third on the left, you're somehow talking to OpenAI, and if you accidentally tap a different button, you're now talking to Gemini?
Yeah, well, so this is real-time breaking news, so I don't have a firm answer, as in all I've seen is this is specific for Siri, But my understanding is Siri was supposed to be kind of the lead-in to Apple Intelligence. So I'm sure, it would seem that OpenAI is getting a bit pushed out here, as in I'm sure they wanted to be, the underlying model for Siri. So we'll have to see how this, the former relationship with OpenAI plays out with Apple. They have previously said they want to be open to all models, but they're clearly picking a favorite right now. And I'm sure that over time they'll end up kicking Gemini out once their foundation models can do, whatever they need them to do.
This is absurd. All right, so start with like the way the economic dynamics are changing for Apple here. Okay. Previously, to be the default search engine on their browser, Google had to pay them, what was it, $20 billion a year. A year. Now Apple, to be the next information engine, is having to turn around and reputedly pay Google somewhere around $1 billion a year. So they're net losing $21 billion a year on people trying to find information through their system on the way the economics are shifting. I think Apple's in huge, hairy trouble. And it's not just this, it's like Ben Thompson has this great piece out on the Vision Pro and how they're totally botching live sports on the Vision Pro today.
I was going to bring that up. The courtside experience is subpar.
Right. They just don't have taste anymore. They have like the raw foundational material to be like, hey, we could do this in a really slick, interesting way. And the company seems to have lost its ability to curate. And I don't think that with the existing C-suite, that is going to magically reappear. Now, so I think Apple, like, this is a sign of Apple's continued weakness. I laugh at the idea that somehow by paying Google $1 billion a year, that's going to transmogrify into some foundation model that's going to be useful for Apple, qua Apple, like within Apple. I just think they're kind of floundering and kind of throwing up their hands. Apple Intelligence is, my wife actually asked me to turn off kind of the feature because she accidentally triggers it. She's like, I have to stop having this thing happen to me. So the features as currently delivered are clearly not used by anybody, and kind of switching from one model provider to another is going to continue to provide not used by anybody, but now they're paying $1 billion a year for somebody to not use it rather than getting it free from OpenAI. On the Google side, this is clearly a sign that Google has talked to Apple and said, hey, we can save you from this strategic disaster you're in, and Apple's agreed to it. I don't know that it net helps or hurts Google, but I think that the Gemini team is clearly delivering good product and trying to figure out distribution for it.
Can I ask a question? So OpenAI was working with Apple, and yet, I mean, my experience and people I know their experience, using Siri did not get any better.
It's because you often wouldn't go to OpenAI. To go to OpenAI with Siri, didn't you have to click triggered into it and you had to approve that you were going to do it? So I'm sure nobody has used Siri to use OpenAI.
It wasn't automatic.
Yes. Presumably this relationship would be structured in a way where it's more kind of like natively embedded, where Gemini just lives on the iOS operating system.
Mm-hmm. Here, this is.
Well, that's why I think this might. But talking on the friction point, that's like a good case why it could be a big deal for Google, where it's like, right now it's fairly easy to get to any, model that you choose, and everyone has their default. But it's like if Siri is actually if all Siri does is just clicking the microphone button to Gemini, then that's like a extremely low friction and probably useful mechanism where that could become a lot of people's default.
Before we continue, we have breaking news. This is all breaking news. So this is news from Google. This is the account on X. I'll just read it. Apple and Google have entered into a multi-year collaboration under which the next generation of Apple Foundation models will be based on Google's Gemini models and cloud technologies. These models will help power future Apple Intelligence features, including a more personalized Siri coming this year. After careful evaluation, Apple determined that Google's AI technology provides the most capable foundation for Apple Foundation models and is excited about the innovation new experiences that this will unlock for Apple users. Apple Intelligence will continue to run on Apple devices and private cloud compute while maintaining Apple's industry-leading privacy standards.
Okay,
This
so then I
seems
take
like a
back what
very
I take.
specific
I,
Apple Gemini SKU that they're going to work together. So this isn't just the Gemini that everyone gets on
yeah.
the app.
But on,
Joint partnerships between big tech conglomerates are usually a recipe for total
Right.
success and great, fluid, amazing, frictionless experience.
Well, that's what I was going to say. I take back what I just said because it sounds like Apple's going to take Gemini, make it worse, and then put it in your phone. And so it's
Yeah.
like, it's not good.
And
It's not good for
but
Apple
Google's doing it because
or
they get
Google.
some TPU business out of it. Like GCP is involved here clearly. So Apple, there's like a enterprise sales angle. There's sure, we'll help you along, but we're not really going to. And like one way to think about it from the Gemini perspective, is this net better or worse than their kind of Android distribution? Their Android distribution is they have much more volume there. Apple iOS globally is like what, 20% of the smartphone market or something. So this maybe fills in a piece for them, but I think it's probably more enterprise sale driven on the GCP side.
Can I ask another question? The person rumored to succeed, Tim Cook, what's his background? They've had just a rotation of management teams around anything AI. Does this guy have the chops?
He's a VP of hardware engineering, John Turnus. And there was also, this is great that you brought this up, Cathie, because there were more rumors that came out this weekend around Tim Cook. He allegedly told people he was tired. He's, looking to get out potentially. So this could happen, this management change could happen faster than most people think.
Mm-hmm. Interesting.
And
Okay,
I also think maybe
It's a 50-year-old company. This is it's really kind of amazing to think about. It's a half century old. It's not a surprise that this is a company that's looking more like IBM than it is looking at like some disruptive kind of like nimble, mover.
It would be really interesting to hear what Apple management thinks about AI generally, like what direction they think AI is going, because then you'd be able to read into this decision. Because the way that I understand this is they're probably saying, okay, we're behind, right? And to catch up, we're going to need to deploy tens of billions of dollars into compute to build our own foundation models. Instead, they're going, hey, let's go to our friends over at Google. Let's license Gemini. Gemini is at the frontier of most of these benchmarks. Let's license that technology, bring it into Siri, and then deploy different features that we know will be great for our users. Now, the problem, Brett, is that when you do that, you're beholden to updates from Google, right? Like Gemini, If you're using Gemini technology, then your technology only gets better when Gemini technology gets better, which I think is a safe bet for Apple to make, going, well, Google's always going to be deploying, tens of billions of dollars compute, so Gemini is always going to be getting better. So all we really need to do is essentially fine-tune this model for what Apple users will use it for, which may not be
all we really need to do. There's like a really telling, actually very close parallel here, which is Microsoft has open, unfettered access to OpenAI's IP from the start and continuously to fine tune it and refine it to deploy just against its Office suite as Copilot. And far and away, the most useful use of these tools is in, at least in terms of productivity delivering, is in using basically like knowledge worker Office products, of which Microsoft dominates. And you can survey everybody, and everybody hates Copilot, and people love Claude, they love OpenAI, they actually like Gemini, like they like things that are not the kludgy attempt to integrate with the existing product software suite. I think that's a strong sign that, Apple at further arm's length from Google with kind of lesser AI talent is not going to be able to take this thing and turn it into this thing that suddenly becomes a magical consumer experience. It's almost astounding how bad Copilot is, given it should be the same underlying model as OpenAI's model. In fact, Copilot should be dominating kind of enterprise productivity use of AI because of their distribution advantage. And it's demonstrably not. we need to learn from that lesson here on the consumer side as well.
All right. Do we want to end there, or I have one more tangential topic since we're all gathered here? What else we got going on? Which is, I was just thinking about this because this is humanoid robots, and it's like there's another announcement today, and it's everything is just like so high production value, and it feels like top down trying to like cram onto the world. It's like, here is the use case. And it very much feels like that's not how innovations historically have happened, where it's like, you know, people are using something and it's like, oh, this is weird, whatever. And it's like, maybe it's because the capital requirement is so high that you need to do all of this and like give the fundraising story as it is, and maybe it's just a little early. Do you
remember the company Magic Leap?
Yes,
Yeah.
I do. I remember
Okay.
that.
So AR company.
Before we do that, what was the announcement?
Yeah. What was the announcement? Give us the,
okay. So this was 1X Neo. It's a humanoid robot. It's actually very interesting. Like they're deploying to people, and I believe it's like teleoperated. But they were announcing that they have like a worldview model that they're releasing where you can say to the robot, do something, and it's trained on internet data and then post-trained on robotics data, and so it can, you know, lift toilet seats it's never seen before, and yada yada yada.
I mean, so their business model is interesting, where it's like, hey, can I have a robot that is partially, and I don't know how much, teleoperated from a low-wage country that then does the cleaning of the toilet, and that produces data for them that allows them to increasingly automate those tasks. And you need to get by some of the like consumer discomfort with the fact that this robot is not just an autonomous robot that's yours, but it's also, you know, a device that somebody is looking in on your house that you don't know who they are. So I'm not sure it will work in the market, but I think that the business model idea is interesting. The reason I brought up Magic Leap is because AR is still a technology that we haven't figured out how it's going to be useful in a productized way. And this was probably 10 years ago that Magic Leap came out with this video that was these kids sitting in an auditorium, and a whale bursts out of the floor, and everybody's like, whoa, you know, and you're like, how did they do that? And of course they didn't do it. They didn't do anything. They just produced a like highly expensive CGI rendering of what it might feel like to wear these glasses. Fast forward however many years, they've spent $1 billion spinning up manufacturing to manufacture the glass that produces like a little postage stamp sized thing on the end of your frame, and they couldn't sell it into consumers, and the company died. And I think the concern when you have that high production value as opposed to actually demonstrated kind of like, this is what the thing does, is that you're spending so much money on trying to hype up the technology, you're not focused on actually delivering the technology.
Well,
one of the reasons that I think Elon's companies are really interesting, or certainly SpaceX. SpaceX gives you the engineering rendering they're working on to understand how to solve the problem as the promo video. And so it really is like at least a closer match to what they're designing, rather than having a separate marketing team be like, we have to jazz this up, and just coming up with random stuff.
So I'm going to give a plug to our research. It's been really interesting for me to watch our humanoid robot research evolve, because we've been saying, this is really hard. It's really hard. It's 200,000 times harder, or maybe I'm exaggerating, than a robotaxi. And this is going to take a long time. People are overestimating. And yet, I think, given our latest research, haven't we determined that it's possible, especially if Elon's driving the program, to have a humanoid robot, fairly flexible humanoid robot, in 2028? That's not that long.
I would say late 2020s is possible. But there's a I mean, and Sam, you can jump in here too, but that is preconditioned on you're throwing $100 billion-ish at AI compute and that's what's magical about markets. It's kind of, if people believe it, then people will fund it. if enough people fund enough of them, then one of them will kind of like figure out how to make it work and then be able to attract the capital to make it work. And if people don't believe it at all, then you will never actually push money into the game, and so it will never work. Now, Elon is like a unicorn here because he has a cash flow generation engine that it can allow it to self-fund regardless of the kind of like consensus belief. Right now, we're in a lined up period where people are very excited by it, and it requires a lot of capital. And so there's a lot of companies that are like making bids, but there will be a winnowing. I can guarantee that.
Oh, there absolutely will be. But I wanted to say that I think this is telling us something about risk appetite generally starting to increase because ChatGPT moment, AI, more and more people casting around saying, okay, this is going to have significant ramifications. I better be positioned, right?
Mm-hmm. And I think that the ROIC potential here is absurd, right? If you can produce a humanoid robot that does for $25,000, that what's the productivity delivery if it's human like Sam and operating whatever we model 24 hours?
Yeah. It's like the human full-in labor cost over 10 years is like $500,000. So take a robot and say, even call it $100,000. There's 5x, but 5x. And then that's like 5x raw, not including the fact that
cash for cash. Yeah,
right.
There's like
turnover,
more complexity than that, but the net economics are so obvious that then people are willing to take a risk on, if I can deploy capital to get that thing to market, it's clear that it's worth the upfront capital thrown in. And that's, I think, where we are both on the AI side. Clearly the foundation model companies are making that bet because they're not just paying for inference, they're committing to tens and hundreds of billions of dollars of spend on underlying compute to power the next models, because there are, we think, and many agree, trillions of dollars of opportunity in kind of like supercharging productivity of knowledge workers. Humanoid robots, the same thing on building physical stuff in the world. There are trillions, maybe even tens of trillions of opportunity in delivering like a truly working human form factor. So then in that context, what's $100 billion? It's a worthy risk for somebody who's the richest guy in the world. And if he's going to try to do it, then, funders are going to try to find others that can compete with him. So I think it's both risk appetite, but it's also the size of the potential returns here are unprecedented. And so, of course, that's motivating capital in. It's taking capital from really kind of poor uses of capital into more interesting uses. Mm-hmm. And then circling all the way back to the housing cost thing. And I think that almost the original sin in housing should not be that great an investment. And the only reason it's perceived as a good investment is because it is the asset against which you have the biggest permission to take leverage against it. So your return on equity can look very good.
Let me introduce you to some crypto websites, Brett.
But that's actually what the promise of DeFi is. Actually, a lot of assets that previously were hard to take leverage against can become leverageable in a more profound way. And so there over time, I think there will be more competition against housing for other kind of efficient, leverageable, financialized assets. And so housing as an investment class will actually kind of like diminish in importance. We'll see.
Well, everyone needs a roof over their head. And there's a supply and demand issue.
Yeah, I was going to say, it's like part of it's like there's the leverage point, but then there's also the supply constraint, right? It's one of the things that almost everyone is universally against building more housing.
Well, you know what's interesting about that, Sam? So if you look at, I've heard a few commentators say, there is no housing out there. But if you look at new homes for sale, they are, meaning the builders are carrying this inventory, they are near record highs, almost as high as they were in 2007 when we were in the middle of a housing boom that went bust. So I do understand that a lot of people are trapped in their homes because to move would double or more their mortgage payments. But in terms of supply out there, it is starting to build, and I think I think we will see house prices come down. We're already seeing it. KB Home, their pricing down 7% year over year, and I think it was Lennar or D.R. Horton down 8%. So
Yeah, and it's so geographic
yes,
specific.
true.
But and
Very
it's
true.
to the blue geographies. So they're so absurd in their restrictions on housing supply that it's almost amazing that people agree to live in the state of California anymore at all. But here I am, but you can go to Austin where there's like less supply constraint and rents are down,
Yes.
and I'm sure you can get a house for cheaper, but you'd probably be better off going to a single family builder and say, hey, I'd like to sign a 10-year rental lease on this property. And lock in, because like the reason you buy a house is so that you have certainty on housing costs over a meaningful chunk of time. Like that's the option value you're buying, but you could just negotiate a longer lease and then kind of take the capital that you would otherwise deploy to down payment and, I don't know, invest in Bitcoin or something. You probably do better.
Easier said than done. Okay, to wrap up, that was not a dig on 1X, just more of an observation on the humanoid robotics industry as a whole. Brett or Nick, is there a poly market or Kalshi market you guys want to take a stab at? All of the trending ones are Iran related. I don't know if we want to go there, or there's next president of the U.S., which we could jump into.
Well, what's the betting? What's the betting on both?
Okay, so for will the Iranian regime fall before 2027 is now at 47%.
Up from what?
Up
from 11%.
10%.
Yeah, 11% from December 26th. 10%.
Interesting.
Okay, let's go with that one.
All right.
Hazardously treading into terrain that we don't know that
Yes.
much about. I mean, so my wife, during she's a lawyer, so she was working for some human rights organization that was just trying to document what was happening. This was the original kind of like Twitter uprising in Iran. And I remember she was basically screenshotting tweets, like that was her job, like just like capturing all of this data before it disappears. And I remember at the time, it really felt like reform was going to happen, like there was enough political motivation to shift things around. And as it turns out, it didn't. And
Well,
I
that's
also
because the
think
U.S. did not support it. Was that the green face, the Green Revolution?
Green
The
Revolution, yes.
The U.S. did not support it, and it's completely different now.
Well, right. That's the wild card here. As in the other analogy I think of is in Syria, where, Assad is his name, right?
Yeah.
Where Assad, basically, it looked like he was in trouble, but it turns out if you're maximally cruel, you can forestall, you can basically just kill people, and you can kill people until they stop. And right now, it seems like Iran, the regime is in that phase of killing people, at least from what we can tell. And I think that is rather effective as a means of, retaining and consolidating power, absent some kind of intervention from outside.
Well, that's
so,
what this is about. That's
Right.
what this is about, the U.S. involvement. And it is shocking
Yeah.
because President Trump said he wasn't going to interfere in other countries' affairs, but this is different.
yeah.
And it is interesting. So it's like I've seen a lot of press on these types of markets because everyone wants some indication. This market only has $1.3 million worth of volume.
This is also the first market I've ever seen that has a disclaimer attached to it. So if you look at the top of this market, it says, note on Middle East markets. The promise of prediction markets is to harness the wisdom of the crowd to create accurate, unbiased forecasts for the most important events to society. That ability is particularly invaluable to gut-wrenching times like today. After discussing with those directly affected by the attacks, who had dozens of questions, we realized that prediction markets could give them the answers they needed in ways TV news and X could not. I've never seen that before on a market.
Well, what's interesting, and one of the reasons they're doing that is because of what happened after Maduro was
Right.
arrested, right?
Yeah.
And
Yeah.
so they had to cancel those markets because the question had to do with war, and this was not considered war, something like that, right?
Right. Yeah. There was like a big, I think misunderstanding in what the market meant and what U.S. invasion of Venezuela technically looks like. So people were upset that the market didn't resolve in their favor or not. Yeah.
Okay, well, I'm going to go with no. I think that nothing ever happens, and it's one thing to waltz into Venezuela and spear it out of the country with Maduro. I think it's another to try to disrupt the regime in Iran from externally, given how long they've invested in basically trying to protect themselves against that exact thing.
I'll take the other side of this only because it does seem, whether as we're analyzing Venezuela, that there was a bit of an inside job, and I wouldn't be surprised, especially because Trump. Oh no, I guess we got Soleimani. Was that Trump also? Maybe not.
Yes.
But that was an inside job, and my guess is there's a lot more infiltration because the people want to get out from under this theocracy.
Well, right, and it's a question of are those people close enough that they can kind of like inform the ability to depose the regime? I mean,
well,
these are dark
47% up
times,
from
but-
10. Let's keep
Yes.
watching.
There's
All right.
definitely something happened. Wait, Nick and Sam, where are you at? Yes, no.
I'm going no, because if only, again, I read the definition of what has to happen for this to occur. It's like, even if there's like a partial revolution, but not a total uprooting of all of the various organizations,
The
then
theocracy, you mean?
yeah.
Only
like,
only a
it's
clear break in continuity, such as a new provisional government, revolutionary council, or constitution replacing the Islamic Republic, will qualify.
Right.
So
And it's like, I think anytime there's a power vacuum, you never know which direction things reemerge.
I don't know. This
Nick?
is the third. Sorry. This is the third try, right? The Green Revolution. Then there was another attempt, no U.S.
Yeah.
support, and now this one. So
I'm
Nick's going yes.
Yeah, I'm gonna tell Cathie. I'm going yes.
All right, good. Split
All right.
council.
This
We'll
was
see.
a true brainstorm, Cathie. Always good to have you
thank you.
on.
This was fun.
And we'll see everyone next week.
Thank you, everyone.
Thank you.
ARC Investment Management LLC is an SEC-registered investment advisor. ARC, Wolf Financial, and Public are separate, unaffiliated entities and do not have a relationship with respect to any company marketing or selling the products or services of the others. ARC, Wolf Financial, and Public make no representation or warranties regarding and expressly disclaim any responsibility or liability for any acts, omissions, losses, or damages of the other entities or their affiliates, officers, employees, or agents. No company shall be liable for any indirect, incidental, consequential, or special damages arising out of or in connection with this podcast or its contents. The information provided in this show is for informational purposes only and should not be used as the basis for any investment decision and is subject to change without notice. It does not constitute either explicitly or implicitly any provision of services or products by ARC, and investors should determine for themselves whether a particular investment management service is suitable for their investment needs. All statements made regarding companies or securities are strictly beliefs and points of view held by ARC and/or show guests and are not endorsements by ARC of any company or security or recommendations by ARC to buy, sell, or hold any security. Historical results are not indications of future results. Certain of the statements contained in this show may be statements of future expectations and other forward-looking statements that are based on ARC's current views and assumptions and involve known and unknown risks and uncertainties that could cause actual results, performance, or events to differ materially from those expressed or implied in such statement. ARC assumes no obligation to update any forward-looking information. ARC and its clients, as well as its related persons, may, but do not necessarily, have financial interests in securities or issuers that are discussed. Certain information was obtained from sources that ARC believes to be reliable. However, ARC does not guarantee the accuracy or completeness of any information obtained from any third party.